And what about gains? And this again is on number 43. Gains and losses on sales of plant assets. So plant assets, when they're sold, there will be a gain or loss. If you sell it for more than its book value, there's a gain. If you sell it for less than its book value, there's going to be a loss. Gains and losses go into income. Part of continuing operations, not discontinued, could be, you have to remember that this is probably, it depends on the regularity of asset disposals. It might not be part of operating income, but the gain and loss goes into net income. So let's take a look at an example. And we're back to our vehicle, or our truck, and we're saying that we've got the truck for $80,000. That was our original cost. The depreciation, it was straight line. It's accumulated, excuse me. And we know that we did straight line, so it was 80 minus 8, which was the scrap. 5 years, 72, over 5. Just to bring you back, it was 14.4. And we depreciated the asset for a 4-year period. I know I could multiply this, but I just want to show you the entries. So the asset had accumulated depreciation of a book value of 22.4. If the selling price is 25,000, there's a gain on the sale of 26. So if you sell the asset for 25 with a book value of 22.4, the gain is 26,000. That gain goes on the income statement. It's part of continuing operations, probably not part of operating income, but it's part of your continuing operations. Now, in making the journal entry, however, that's just a calculation, you have to remove the cost and the accumulated, you have to remove the net book value. So the first step in the debit and credit is you have to remove the book value. You have to remove the cost and you have to remove the accumulated. So when you make the journal entry to record the sale, and the journal entry is coming right up, but I'll put it here. You know you've got cash. This is a compound entry. The first thing we do is we remove the book value. You remove the cost of the vehicle by a credit of 80. And you debit the accumulated account for the depreciation. The difference between the two is going to be the gain. Increase cash, and then record the gain or loss. and you have to have removal of the book value of the asset. So that's one way we dispose of the asset. In intermediate, we look at other ways, trade assets in or swap assets, but this is the sale. So the sale is a pretty straightforward transaction. In fact, if you look at the, there's the journal entry, and once again, you've got to make sure that the assets account is reduced for the truck that you sold and the accumulated. You remove the net book value of that asset. Now, the only other way the asset could, in this course, be changed is through an impairment. And an asset impairment is a write-down that we can take, and I'll just show you a little bit about that in a second. All right, so any questions on this transaction, on the compound entry, to record the disposal of the asset? If you sold it for less than its book value, sell it for less than 22.4, gain, loss. All right, so loss would be recorded. And the loss, of course, would be debited in that, just like an expense. Remember, we said this early in the course, gains are the same as revenues, except they're coming from non-recurring or non-operating sources. Losses are expenses, in a sense, except that they're coming from non-operating sources. And the loss would be debited in this case if you sold it for less than the 22.4. So for example, if you sold the asset, in this case, let's make it easy, you sold the asset for $20,000. If you sold the asset for $20,000, there's a loss of $2,240. So what would happen in this case? It should be 2004. 2004. All right, so loss is 24. And of course, the truck is still at 80. So loss is debited like an expense. And of course, you remove the truck, the accumulated, which is the book value, and then record the cash, and then the loss is due. So that is, and as I said, in intermediate, we will look at other ways to dispose of assets, trade-ins, swaps of assets as well. All right, so any questions on that? We have one more thing to do, and then we'll take a quick look at intangibles. All right, that last issue is an impairment. When we look at an impairment, we have to look at the issue of whether or not the asset no longer is going to be able to produce benefits that are equal to the carrying value of the asset. And although we're not going to get into too much detail in this course, what we have to do is look for impairment indicators. You would have to think about whether or not the asset is going to be used in production. So if you have a piece of equipment that's manufacturing a product and that product is no longer as popular in the marketplace as it once was, then that piece of machinery may not be as useful in the future. That asset may be impaired. That impairment loss has to be recognized by a write-down on the income statement and also a reduction of the asset. Now, the way we do this is we look at, and this is not a very, I think, reasonable test, it's not a great test, but we project, we look at the future cash flows we expect from the asset. we add them up, and then we determine whether or not they exceed the carrying value or not. And if the undiscounted cash flow, so let's say you've got an asset today, and the net book value of that asset is 300. These are cash flows expected. If you expect to get, and this, by the way, we know it ignores time value of money. We will debate that next semester. But if you add up the undiscounted cash flows, they're 400. If the undiscounted cash flows exceed, the sum of the undiscounted cash flows exceed the amount of the net book value, then there is obviously no need, there's no impairment. If the cash flows are less, then there is. Now, that is not the impairment loss, but that's just a test that we would do. We would look at the undiscounted cash flows, and in this case, that the undiscounted cash flows exceed the expected amount, or the expected book, the net book value. If, on the other hand, I change this, and I change that number, let's say, to 200, I project the cash flows out, and that's going to be 200, and then in that case, there's an impairment. Because the cash flows are less than the net book value. Now, this is just an arbitrary test. Once you find out there's impairment, the loss is the fair value minus the net book value. So the actual loss you take would be the fair value minus the net book value. So let's say you get the asset appraised, and let's say the fair, I'm just going to give you these numbers. The fair value is 250, and the net book value is 3, then the loss is 50. And what you would do is you would debit a loss on impairment, and you'd credit the asset. You notice you reduce the asset directly, and that would be the way the asset would be impaired. I mean, obviously, you do have some problems that it could be, over because of the estimates here, and because this fair value is an estimate. Where are you going to get a fair value from? Where would you get the fair value from? You'd have to get someone to appraise the asset. That could be subjective, so that loss may not be as a reliable number as you would want it to be. But again, you think about the relevance of reporting an impairment. If you know the asset is not going to be as useful, you take some type of loss, which is a signal to the reader that the asset may not be generating as much income in the future, even though the number is not exactly 100% accurate, but the loss is going to be taken. Okay? And that's exactly what we're showing you here. Just again, it's going to be a reduction of net income. And sometimes assets get impaired for restructurings as well. All right, the only thing I was going to say is that when you think about US GAAP is more conservative. What would have happened if the fair value exceeded the net book value under US GAAP? What if you had your assets appraised and they were higher than they were on your books? Would we recognize the gain?
Still stay at the cost.
Yeah, it stays at cost under US GAAP, but under IFRS, and I'm not worried about the aggressive breakdown, but under IFRS, just to let you know, this last bullet, I'm not going to worry about their impairment, so you can skip that. But right here, we'll see this next semester, under IFRS, assets can be written up. You can elect to write assets up to fair value. The new depreciation is going to start at 250. Right? The new depreciation will start at 250. All right. All right, this Walmart's footnote. So just to let you know, they're using straight line. I'm going to go right to intangibles. Again, just to tell you, this is an actual footnote. And I guess the authors put this in to let you know that we're actually showing you things that really exist. So plant and equipment are stated at cost. Gains and loss on disposal are recognized as earned or incurred. They go into the income statement. Cost of major improvements are capitalized, while cost of normal repairs and maintenance are expensed, the capital versus revenue expenditures. And they're not going to give you the table, but they summarize the property, plant, and equipment, the useful lives, and they said they're using the straight line basis. So a lot of the things that we've covered in the course so far.